Imagine waking up one morning to a headline that reads, "Every country on earth is broke." The United States, China, Japan, Germany, the UK, every flag you can picture, every anthem you've ever heard, all united by a single staggering fact: they owe more money than most of us can even imagine. The numbers are so big, they barely feel real. The U.S. alone owes $38 trillion, China $18 trillion. Japan's debt is more than double the size of its entire economy, and yet the world doesn't stop spinning. Planes still take off, factories still hum, and governments keep spending. If every nation is in debt, who's left to do the lending? Who is the mysterious creditor behind the curtain? Is there some shadowy cabal, a secretive billionaire, or a hidden empire of lenders pulling the strings of the global economy? Or is the truth even stranger? Let's start with the basics. When you or I borrow money, it's simple. There's a lender and a borrower. You take out a mortgage, the bank gives you cash, and you pay it back over time. The bank got that money from somewhere: its depositors, its investors, its own reserves. But when we zoom out to the scale of entire nations, the math gets weird. If every country is in debt, who's on the other side of the ledger? Who is the world's banker? To unravel this, let's look at the United States, the world's largest economy and the poster child for government debt. As of late 2025, the U.S. government owes $38 trillion. That's a number so large, if you stacked $100 bills, it would reach the moon and back twice. But who actually holds this debt? Who are the lenders? Here's where the story takes its first twist. The single largest holder of U.S. government debt isn't a foreign country or a Wall Street titan. It's the Federal Reserve, the U.S. central bank. The Fed owns about $6.7 trillion in Treasury securities. In other words, the U.S. government owes a huge chunk of its debt to itself, or more precisely, to its own central bank. This is like borrowing money from your own left pocket to pay your right pocket, but on a scale that would make even the most creative accountant blush. But the plot thickens. The next biggest category is what's called intragovernmental holdings. This is the government owing money to other parts of itself. The Social Security Trust Fund, for example, holds nearly $3 trillion in government bonds. The Military Retirement Fund, Medicare, and other agencies hold trillions more. Add it all up, and the U.S. government owes about $13 trillion to itself. That's more than a third of the total debt. So, when people ask, who's lending all this money? The answer, at least in part, is the government is lending to itself. But that's not the whole story. The next group of lenders is private domestic investors, ordinary Americans, through their retirement accounts, mutual funds, banks, and insurance companies. Pension funds alone hold trillions in government bonds. Imagine a teacher in Ohio, a firefighter in California, a nurse in Texas. Every month, a slice of their paycheck goes into a pension fund, which then invests in U.S. Treasury bonds. Why? Because government bonds are considered the safest investment on earth. They're the financial equivalent of a sturdy, storm-proof vault. So, in a very real sense, millions of Americans are both the borrowers and the lenders. Their future security depends on the government's ability to keep borrowing and paying interest. Let's pause here and think about the irony. The same people who worry about the national debt, who see the headlines and feel a pang of anxiety, are also the ones who benefit from it. If the U.S. government suddenly paid off all its debt tomorrow, those pension funds would lose their safest, most reliable investment. The system is a loop. Citizens lend to the government spends the money, and the citizens' savings are protected by the very debt they fear. But what about the rest of the world? Surely some of America's debt is held by foreign powers, and that's true. Foreign investors, including governments and private entities, hold about $5 trillion in U.S. debt. China owns around $760 billion, Japan $1 trillion, the UK $723 billion. But here's the twist: these countries don't buy U.S. debt out of charity or obligation. They do it because it's in their own interest. Take Japan, for example. Japan exports cars, electronics, and machinery to the U.S. Americans buy these goods with dollars. Japanese companies end up with piles of dollars, which they need to convert into yen to pay their workers and suppliers. But if they all tried to exchange their dollars at once, the yen would soar in value, making Japanese exports more expensive and less competitive. So the Bank of Japan steps in, buys those dollars, and invests them in U.S. Treasury bonds. The money flows in a circle. America buys goods from Japan, Japan buys U.S. debt, and the cycle continues. China operates on a similar principle, though with its own unique twists. For years, China kept its currency weak to boost exports, accumulating massive reserves of U.S. dollars. What do you do with $3 trillion in cash? You can't just stash it under a mattress. The U.S. Treasury market is one of the few places big and stable enough to absorb that kind of money. So, China buys U.S. bonds not just to earn a return, but to keep the global economic engine running smoothly. This brings us to a crucial insight. U.S. government debt isn't a burden forced on unwilling lenders. It's an asset that investors, both domestic and foreign, actively want to own. In times of crisis, when the world feels uncertain, money floods into U.S. treasuries. It's called a flight to safety. When the seas get rough, everyone wants a lifeboat, and U.S. government bonds are the sturdiest lifeboat around. But America isn't alone in this strange dance. Around the world, public debt has soared to $111 trillion, nearly the size of the entire global economy. The U.S. and China together account for more than half of all government debt on Earth. Japan, with its famously high savings rate, has government debt equal to 230% of its GDP. If Japan were a person, it would be like earning $50 a year and owing $115 and yet Japan's economy keeps chugging along. Why? Because almost all of its debt is held by Japanese citizens, banks, and pension funds. The money circulates within the country, creating a closed loop of borrowing and lending. So, if every nation is in debt, and the lenders are often the citizens themselves, what's really going on? The answer lies in the way modern money works, a system that's both ingenious and precarious. And to understand it, we need to look at the most powerful tool in the central banker's arsenal: quantitative easing. Quantitative easing, it sounds like something out of a science fiction novel, but it's one of the most important and misunderstood forces shaping the global economy today. At its core, quantitative easing, or QE, is the process by which central banks create money out of thin air. Not metaphorically, but literally. With a few keystrokes, the Federal Reserve, the European Central Bank, the Bank of Japan, and others can conjure billions, even trillions, of dollars, euros, or yen into existence. They use this new money to buy government bonds and other financial assets, injecting liquidity into the system and keeping interest rates low. Why do they do this? The answer is both simple and profound. In times of crisis, like the 2008 financial meltdown or the COVID-19 pandemic, private lending dries up, people get scared, banks become cautious, businesses stop investing, the economy grinds to a halt. In these moments, governments need to step in, spending vast sums to stabilize the system, bailing out banks, sending stimulus checks, building hospitals, keeping the lights on. But where does the money come from? In normal times, governments borrow from investors, but in a crisis, when investors are running for cover, the central bank becomes the lender of last resort. It creates money, buys government bonds, and ensures that the government can keep borrowing at low rates. This process is both a lifeline and a double-edged sword. On one hand, it prevents economic collapse. On the other, it can fuel asset bubbles and widen inequality. After the 2008 crisis, central banks around the world unleashed waves of quantitative easing. The result: stock markets soared, real estate prices jumped, and the wealthy, who own most financial assets, became even wealthier. The Bank of England estimated that QE boosted stock and bond prices by about 20%. But 40% of the stock market is owned by the richest 5% of households. So, while QE saved the economy, it also made the rich richer, leaving many ordinary people feeling left behind. But let's return to our central question. If every nation is in debt, and central banks can create money at will, is there any limit to how much governments can borrow? Can we just print our way to prosperity? The answer, as always in economics, is it's complicated. In theory, countries that borrow in their own currency, like the US, Japan, or the UK, and never run out of money, they can always print more to pay their debts. But there's a catch: inflation. If too much money chases too few goods, prices rise and the value of the currency falls. In extreme cases, this can spiral into hyperinflation, wiping out savings and destroying economies. Think Zimbabwe in the 2000s or Weimar Germany in the 1920s. For major economies, the risk is lower, but it's never zero. The real constraint isn't the ability to pay, but the willingness of people to keep trusting the currency. This trust is the invisible glue holding the system together. As long as people believe that government bonds are safe, that central banks are responsible, and that inflation will remain under control, the system works. But if that confidence wavers, the consequences can be swift and severe. We've seen it before. Greece in 2010, Argentina time and again, Russia in 1998. When investors lose faith, interest rates spike, currencies collapse, and governments are forced to make painful choices, cutting spending, raising taxes, or defaulting on their debts. So, what does all this mean for the future? Are we heading for a reckoning, or is the system more resilient than it appears? The answer depends on a delicate balance of forces. On one side, the demand for safe assets, government bonds, remains strong. Aging populations in wealthy countries need secure places to park their savings. Pension funds, insurance companies, and banks all rely on government debt as the backbone of their portfolios. As long as this demand persists, governments can keep borrowing at low rates. On the other side, the pressures are mounting. Global debt is at record highs. Interest rates, after years near zero, are rising. Servicing the debt is becoming more expensive. In the US, interest payments on the national debt have soared to $1 trillion a year, more than the country spends on its entire military. That's money that can't be used for schools, infrastructure, or healthcare. It's a growing burden, and it's not unique to America. Across the developed world, governments are spending more on interest than on defense, and in many cases, more than on education or health. For developing countries, the situation is even more precarious. Many are caught in a debt trap, spending huge portions of their budgets just to pay interest on loans. In 2023, poor countries paid a record $96 billion to service their external debt. Some spend more on interest than on schools or hospitals. The result is a vicious cycle. The more they borrow, the more they owe, and the less they have to invest in their own future. It's like trying to swim while carrying a backpack full of rocks. So why don't countries just walk away from their debts? Why not default and start fresh? The answer is that default comes with a heavy price. It means being shut out of global credit markets, watching your currency collapse, and seeing your economy spiral into chaos. No government chooses default unless there's no other option. For major economies, it's almost unthinkable. They borrow in their own currency, and they have the tools to avoid default, at least for now. But the system is not invincible. It relies on a series of fragile agreements, that governments will act responsibly, that central banks will keep inflation in check, that investors will keep buying bonds, and that the global economy will keep growing. If any of these assumptions fail, the consequences could be dramatic. The world has never seen debt levels like this in peacetime. The margin for error is shrinking, and yet there's a paradox at the heart of it all. The world needs government debt. Pension funds, insurance companies, and banks depend on it. Central banks use it to manage the money supply. Safe assets are valuable precisely because they are scarce. If governments tried to pay down all their debt, there would be a shortage of safe places to invest. The financial system would become less stable, not more. So, who is the lender when every nation is in debt? The answer is all of us. Through our savings, our pensions, our insurance policies, and our central banks, we are both the borrowers and the lenders. The system is a vast web of mutual obligations, a global balance sheet where every liability is someone else's asset. It's a system that has enabled unprecedented prosperity, but also one that carries real risks. The future will depend on how we manage those risks. Will governments find the discipline to control deficits? Will central banks keep inflation in check? Will the global economy keep growing fast enough to outpace the debt? Or will we reach a tipping point where confidence falters and the system unravels? No one can say for sure. But one thing is clear: the story of global debt is not just about numbers on a balance sheet. It's about trust, cooperation, and the choices we make together.